Hello, this is Alan Kendall, and this is the Warren Buffett value formula that I invented. And Warren likes to get as much value possible for the least price. And so I invented this value to price ratio. If you take the percent net profit and you add the percent dividend and you divide it by the price to book, you get some idea of the value to price. And so let's see how this works. Scores that are less than 2. The company is in a weak industry with unions, high maintenance costs, and high price competition. Goodyear tires, they are losing 3% a year. They don't pay a dividend, and they're selling for over 4 times the price of their assets. They come out with a score of minus 0.6. Ford Motors, they are losing 12% a year. They don't pay a dividend, and they're selling for 50% more than their assets. They have a score of minus 8. Airlines, grocery stores, and auto manufacturers usually fall into this category. Warren will avoid them like the plague, and he wants high rates of returns for low prices. He doesn't want low rates of returns for high prices. Scores that are between 2 and 10 have less price competition and some franchise value. ExxonMobil has a 9% net profit, a 2.4% dividend, but they're selling for 3 times the price of their assets, so their score only comes out to 4. Burlington North, which Warren recently purchased, has 11% net profit, which is very good and has been rising steadily over several years. They pay a 2% dividend, and they're selling for 2 times the price of their asset. Their score comes out to 6. Microsoft has a 20% net profit, a 2% dividend, but they're selling for more than 5 times the price of their assets. Their score is 5. Apple has a 15% net profit, but they're selling for 5 times the price of their assets, so their score only comes out to 3. McDonald's has a 19% net profit and 3.5% dividend, but they're selling for 5 times the price of their assets, so their score only comes out to 4.5, which is actually, these are all average scores, and they might go up or they might go down, but Warren is all for the sure thing. And so we see that scores that are greater than 10 have strong monopolies, high rates of return, and must be selling at a low price for the score to be greater than 10. ConocoPhillips has a 7.5% net profit, a 4% dividend, and is selling for 0.8 price to book, which means they're selling for 20% less than the price of their assets. So that makes Warren feel more comfortable. The low price to book, that has a score of 14, a whopping score of 14. Energy has a 16% net profit, and they're also selling for 0.89 price to book, which is 11% less than their assets. They come out with a score of 18. Warren recently purchased both of those companies. Disneyland has a score of 9.3 because they're selling for only 28% the price of their assets, and that's a very high score for Disney. Edison is selling for only 2% more than the price of their assets, and their score comes out to 13. Reynolds American has a score of 10, and they're selling for 85% more than the price of their assets. They have high nets and a high dividend, and so they're actually selling at a good price to book. And so Warren, he's all for the sure thing. He wants to buy companies that have scores that are around 10 or higher, and we see how the value formula can be used to separate the strong industries from the weak and the strong companies from the weak companies. This has been Alan Kendall. Have a nice day. Bye-bye.